Hello and welcome to Super Insider, Australian Retirement Trust podcast series on superannuation, investing and retirement. My name is Anne Fuchs and I'm the Executive General Manager of Advice, Guidance and Education here at Australian Retirement Trust, and we help our 2.3 million members make really great decisions about their precious retirement savings. Before we begin, it's important to remind you also that this is general advice only and you'll need to think about if it's right for you. With me on Super Insider today are two people who are experts in all things investments, and obviously investments is a massive part of superannuation and retiring well. They are Andrew Fisher, who is our Head of Investment Strategy, and Liz Kumaro, who is our Head of Corporate Private Assets. Now, look, it's wonderful to have you both on the show.
Wonderful to be here. Thanks for having us.
Yes, good. Be excited. You know, we've had Brian Parker on the show so far, and we were talking about the market outlook and what people can expect in terms of investment performance. And I think because there are a lot of people in the community, our members, that are worried about everything they're seeing in the world and how it impacts their very precious retirement savings, because people are more engaged in their super than ever. We thought it was really important to talk about the role of volatility and risk and how it relates to super. And, you know, recognising Super Insider is a great way for people to build their own personal levels of financial literacy to help make really good decisions. So it's great we've got these experts here on the show. Now, I might start with you, if that's okay, Andrew, and just whether you might be able to just describe what are the different asset classes that you and the team invest to build the portfolios that, you know, our members are invested in.
Thanks, Anne, and thanks for the question. We invest in a range of different asset classes, and one of the important elements we think about when building portfolios of investments for our members is diversification. And so all the different asset classes we invest in are there to diversify those portfolios and help us deliver as best we can the smoothest return outcome that we can for our members. The asset classes that we use, primarily the most important one typically is shares, which most of our members would be familiar with.
Is that your favourite child? If you had
I don't know if I call it a favourite child, but it's certainly, if you think about so delivering long-term returns is really important, and shares are really the cornerstone of that. They tend to be the highest expected return asset class that we use in the portfolio. And then at the flip side of that is fixed income investing. So in the public markets and the sort of liquid portfolio, we invest in shares and fixed income, so bonds, government bonds, and also some corporate bonds. We use cash, obviously. Liquidity is really important when putting the portfolios together. And then we complement that, which is really important for us from a diversification point of view, which I'm sure Liz can talk about a little bit more as well, with a range of different alternative and private asset classes. Property is really important one that most would be familiar with. We also invest quite a lot into infrastructure, and then areas like private equity and private fixed income, private debt.
Okay, I think I counted 7, almost like the Von Trapps, you know, Liesl Brigade over here. So there you go. You rattled off all those asset classes. So Liz, would you mind explaining for our listeners, probably just thematically, I don't know, this is a hard question, what is the difference between volatility and risk? Because I think a lot of people would assume they're the same thing.
Yeah, it's actually probably a difficult question to respond to. How I think about it, and I'd be interested in Andrew adding his thoughts as well, is volatility is the change in prices throughout the journey of holding an asset, whereas I think of risk as the actual risk of losing your money or not achieving your objective. So typically the higher risk, you would expect a higher return for making that investment, and typically that investment will have higher volatility along the path that you hold it.
I think there is maybe a misconception in some quarters, or maybe a lack of understanding that the unlisted asset world, which obviously you're an expert investor in over many decades, is that some of these unlisted, some are riskier than others, some are growthy, some are defensive. And to Andrew's point about diversified, and Brian talks about it all the time too, diversify. Are you able to just maybe explain some of the different types of unlisted assets and what buckets you would put them in terms of risk and then volatility?
Yeah, absolutely. And there is an incredibly large range of risk and return attributes. When we think about the type of investments that are listed on public share markets, there's thousands of opportunities, but in the unlisted investment environment, there's tens of thousands. So the opportunity to invest across the unlisted space is very large, which does provide an enormous number of opportunities, but also very diversifying opportunities, ranging from the lower risk, and it's very similar description that Andrew provided in the private fixed interest space. That is debt instruments. They can be very, very, very senior secured with strong collateral, very income-oriented investments. So we think of them as more defensive assets and income yielding with not much capital growth. All the way up to the spectrum of private equity, which Andrew touched on, and they are investing in companies. And ultimately, whether they succeed or not is dependent on how successful they are at growing earnings over time. And then in between, you've got property and infrastructure. And those assets can, again, vary. But if you think of an infrastructure asset, they're core assets, typically monopolistic businesses or very high barriers to entry. So they have very secure income and cash flows. So that means that they're a lower risk opportunity, but you've also got some assets that are dependent upon GDP growth and volume based. So they will be riskier and you would expect a higher return from those. And similarly within property, a whole range of investments, whether they're in place tenants, long contracts versus developing something.
I think you nailed the answer to that question. So Andrew, then, with that beautiful answer, how do you think about volatility and risk? Because again, I mentioned Brian, just plugging Brian as much as I can, and he was talking about geopolitical risk, and it is on members' minds a lot. So how does geopolitical risk or other risk factors like GDP growth, how does this play into you and the team sitting down and then building the different portfolios for members, particularly the default?
Yep. So I think a really important thing to sort of stay upfront about volatility is, one of the ways we think about volatility is there's two aspects to volatility and risk, and the counterfactual to risk is opportunity. And so what we always think about when we're investing in something, there's two aspects to it, is what is the underlying cash flow profile, what returns you're going to get, but then also how much you're going to pay for them. And volatility presents opportunities at times to buy things cheaper than we might otherwise buy them and deliver higher expected returns going forward. So volatility is good and bad. And one of the important jobs of us and our teams is to make sure that we are using volatility to actually deliver better investment returns over the long term for our members. I think one, important element to that, and you mentioned geopolitical risk, is when we think about diversification, it's not just investing in things with different labels on them. It's investing in things that are going to behave in different ways in different environments. And so in a geopolitical risk event, if something does happen, something like the war in the Ukraine, for example, that had a really serious impact on inflation around the world for a sustained period of time. That inflation is something we think about, well, assets like infrastructure and property, for example, we call them real assets internally. Those are assets that have a really compelling and demonstrated ability to sort of pass through inflation in terms of better revenues. And so that revenue pass through means they're much more diversifying. They tend to outperform in high inflation environments relative to some other assets where inflation can be quite a headwind. So thinking about what do these geopolitical events mean? What do they mean for the economy? And then what do they mean for different asset classes or even sub-asset classes within the portfolios, and trying to be as diversified as possible so that regardless of what might happen in the world, we've got something in the portfolio that's going to offer some positive returns for our members.
And recognising that when you're building the portfolios, if you're starting your working life or ending your working life, you're going to have larger allocations to different types of assets depending on that time through to retirement. And I know many of our listeners are actually retired, and they've it's all they've got. And so this whole theme of volatility and risk weighs on their mind more than probably most. So I don't know if either of you have any reflections on that stream of consciousness I just...
No, absolutely. Like the right investment strategy for each member is potentially going to be different and unique to their personal circumstances. We make it very clear that this is general advice, but we also, for us, it's really important to have available to different members things that are suitable for them. And so when members go to get advice, they can actually invest in something and is best suited for their circumstances. We also have a default life cycle strategy, which we talk about quite a bit, which will sort of seek to provide a pathway where a member, as they age and go through their life stages, they will de-risk their portfolios and have a little bit less risk, because we are really cognizant and aware of the fact that as you get closer to and through retirement, your account balance tends to go up, but your contributions tend to be much smaller as a sort of relative component of that. What that means is you are quite exposed to market volatility on your account balance as you move closer to and through retirement. And so we try to design a life cycle strategy that takes that into account for members.
Do you have any reflections on that, Liz, as someone who has been an investor in, superannuation and for a long time, around the things, say, a retiree might be, what top of the assets that, retirees love because it gives them that sleep at night factor? Is there anything in particular that you've sort of learnt over the years that you've seen out talking? I know you have gone out and, speak at member seminars. Yeah,
and I think it's important. Andrew picked up on another point. It's not just retirees. There are certain members that have low risk tolerances. So in order for them to sleep at night, they need to understand their own personal preferences, their own circumstances. So we spoke about some of those infrastructure assets. They can have very long dated contracts that are very stable returns. Similarly with the private fixed interest, they're contracts where you have very high confidence that you're going to get your interest and capital back at the end. So they're the ones that you can sleep most well at night. But it is important to note that superannuation, even if you are just retiring, can have a very long horizon. And so there is the opportunity to invest in some growth opportunities to make sure that you can generate that additional wealth over time.
Make sure the money lasts. Are you, Andrew, what are you and your team thinking about this year? Because it's, it feels like 2024 is a significant year. There's just so much going on. We have US elections, and I know, and the world just does feel a bit more fragile. Brian would say, if we're building portfolios for years out, we're not thinking in the here and now. Could you sort of, because you're the one doing it, how do you approach it?
Look, I think the best way we would describe the current environment and our thinking around it is it seems quite delicately poised, I guess, from a economic point of view. And so what that will lend us towards doing is thinking about, if we think about sort of the long term, we like to have really diversified portfolios. I think now more than ever, we think that's increasingly important, because the last few years have showed us just how volatile inflation can be and what that can do to markets. It does feel to be moderating, and the sense of things is that inflation is moderating in a quite nice way in terms of what that means for investments, which is really pleasing. But there is certainly some elevated risk around that as well. Inflation is not back down where we'd like it to be really confident about the outlook for the economy from here. And so thinking about having things in the portfolio that, if inflation doesn't moderate in the way we hope it will, those things are going to do okay, but then also having things in the portfolio that will protect us in the event that we have some sort of economic downturn. It is still quite a tricky pathway for, to your point, fragility feels quite high, and so there is quite a lot of risk, it feels like, that things might go in various directions. And so really just a strong focus on diversification. And to Brian's point, really thinking about that long term and making sure our portfolio is going to be really resilient to whatever that fragility might bring to us.
Yeah, okay. So, Liz, if you just park the geopolitical risk, we're also living through an extraordinary time in the role technology, what's happening with technology and electric vehicles and this shift to renewable energy and AI, and, how teachers, hats off to the teachers, any teachers who are listening with kids who just go to Google to do their homework. The education system has a challenge. What are you seeing as an investor around things that are exciting or new that you think our listeners would be curious to hear about? Is there anything that stands out?
Yeah, it's an extraordinarily exciting time, actually. And you touched on it before, that we have to think about the 5 to 10 year horizon. We hold these assets for a long time, and some of these technology innovations that are coming to market now are having some enormous disruptions, both in the positive but also in the negative. And so as investors, we really need to think through what are the opportunities and the threats, and how does that impact our in-place portfolios, and what does that mean for additional investments going forward. If we look at the big investments across the portfolio, you really want to invest in things today that have those thematic tailwinds. And I'd say that the big two thematics that are throughout the portfolio, what you actually touched on, is digitisation and automation and decarbonisation. There are big tailwinds associated with those themes. And so as we look through the portfolio and make investments, they're the areas that we're really focusing on. If we look at digitisation and technology, it's touching all parts of where we...
Of society, yeah.
Absolutely. How we shop, where we go to work, how we live, how we're educated. So there's just an untapped... And the introduction of ChatGPT and AI is really... That was the catalyst of really taking this forward. That has the opportunities to make some of the ways that we live incredibly exciting. It touches all parts of our world. So there are an enormous amount of innovations happening. What we do have to be careful about is AI in itself is an interesting space, and there's an enormous amount of competition. So you'll see a big take-up of things. They'll have a trend, but then something new and shiny will come along and that will go. So the big challenge at this stage of the innovation cycle is what is going to have longevity. So we are really embracing it through existing assets and how they're using it to create productivity benefits.
Benefits, yeah, and trying to work out where is the risk return reward, and how does it, what role does it play? And I guess you're then putting it to Andrew and his team, and you're considering then, how this how it's put into a portfolio overall as an asset class.
Yeah, absolutely, and I think. It's as Liz was going through it, I was sort of reflecting on the COVID period a little bit because I think that has been quite instrumental in terms of accelerating some of these thematics, but it didn't create necessarily a lot of the thematics that we're seeing in markets. It just accelerated some things that were happening. If you look at the assets that perform well, they're things like industrial, warehouse properties, sort of overtaking retail shopping centres a little bit. That was a thematic that was happening anyway, but that shift to online really sped up. And so I think at Liz and teams, what they're thinking about now is how do you sort of think 5 years, 10 years forwards, where are those thematics going? And positioning portfolios and investments that are going to take advantage of it.
Okay. Yes, Liz?
I was just going to say, and what's really important to note is those thematics are well known by the industry. So what you have to be really careful about, if there's a huge amount of money chasing these investments, even the best assets can be the worst investments if you overpay. So being very diligent about the underwriting, understanding how those earnings profiles are going to play out over time, understanding the macro environment and the potential threats to them, to make sure that the price that we pay for these assets are fair and reflective of the forward expected earnings.
And that's really a very good call out, because I think a lot of people could relate to, paying, a beautiful residential home, and they still go, at some point you pay too much and you can't ever get that money back. And so it's really, for our listeners, applying that same kind of analogy, and that's how you're approaching some of these quality assets and at the price you're paying for them.
I think a perfect example, Andrew touched on the COVID environment. We think about what causes volatility in assets, and ultimately fundamentals. It comes down to the earnings, the forward earnings, but it's not just fundamentals. We know that there is market sentiment that comes into play, and ultimately behavioural finances, a whole number of elements. And I look back at that COVID period, and that was the introduction of the meme stocks, where there wasn't necessarily fundamentals, but
meme stocks.
So do you remember the meme stocks?
I'm staring at you blankly. That one passed me by. I'm embarrassed to say.
No, well, GameStop. Do you remember GameStop? I think that was the poster child of the meme stock, where there was social media had the excitement about these stocks, and it really introduced an excitement about them, and it just pushed prices up because they became trendy online. They didn't necessarily have the fundamentals under it, but that's what can create the volatility, and that's why it's important to make sure that...
That's an awesome example. So probably last question, I'll throw, Andrew, to you, is... in your role as head of investment strategy, should you be surprised about volatility, or should volatility never be a surprise to you because there's a method to the madness, so to speak, around how you build the portfolios?
I would say we are always expect to be surprised is probably the way I explain that. So yes, but like you take COVID, we've spoken about it a bit just recently. We did not expect markets to behave the way they expected at the pace and speed at which they did. And so I think of our how we try and manage portfolios is it's less around trying to predict things like that, and because you can't, right? You can't predict those exogenous shocks that come. But what you can do is prepare yourself for how you're going to react when they do come. And so our success through the COVID period was not like predicting what was going to happen, but it was everything we did after that. And it's things like Liz and her teams, when they see investments that have accelerated and had 7 years of a whole 7-year business case work out in 3 because these trends accelerate, it's not sitting there and saying we're going to get 10 more years of that. It's saying, well, okay, that's worked out well. How do we then take advantage of that and move into the next 7 years from here? And so, yeah, it's like the scouts thing, be prepared. That's how we think about volatility, is be prepared for how we're going to take advantage of the opportunities that present.
I guess you do scenario planning, fire drills, all that type of thing.
Absolutely, yes.
Okay. Okay.
We just did one.
Just did one? Gold star, scratch and sniff sticker for you? You did okay?
It went quite well. But one of the fun things about this is it gives the team an opportunity to come up with the most fantastical scenario of what might happen.
Okay.
I've been poisoned once in one of them and couldn't speak, and so I had to sit and watch it. Yeah.
Poor Fisher. So Liz, can you just to sort of round out the conversation at a higher order level, as an investor, what is, I guess, the one thing that you and the team love about what you do? Because how many people are in the investment team now at Australian Retirement Trust? 120?
Approximately 125.
Yes.
Yep.
What is the energy of the place, and what do you think you'd all say that it's the best thing about your job that you all universally love? And I'm guessing it's probably not the volatility surprises.
I'm going to start with first by saying the responsibility of representing our members. I mean, you opened with saying that we represent 2.3 million members, and we are responsible for their financial savings. That's an enormous responsibility, so it gives us great purpose in terms of coming to work. But then, of course, the next part of that is the role that we do, and it's an exciting privilege to be able to talk with and speak with some of the most impressive and successful investors from around the globe. We get to see the insights, hear what's happening on the ground, understand those thematic changes, speaking to the venture world is always incredibly exciting because they're the innovators, they're the disruptors. That's what helps you understand what's coming down the pike and what could potentially impact the more mature companies. So for me, and I think my team definitely, it's the opportunity to leverage some of the smartest minds from around the world and put that into play for our members.
Yeah, doing good. Well, I loved having you both on the episode, and I think, Liz, your point about you could be young and actually be really conservative in terms of your mindset around risk and your fear of losing capital. And I think it's an important reflection just to finish is that money is an emotional thing. Money has a massive impact on people's emotional well-being, physical well-being, and they're picking up things they've learnt from their parents and the cultural. So all of these aspects feed into good decisions and bad decisions when things like volatility is happening in the stock market. So I'm just going to give a plug for financial advice because that's what I do, because financial advisors are very good at actually understanding the psychology and the why so that the portfolio is right for you. So thanks again for coming on Super Insider, and to our listeners and viewers, make sure you subscribe to wherever you consume your podcasts and tell your family and friends. We want more viewers. Super Insider, it's where it's at when it comes to superannuation, investment and retirement education. Thank you very much.